Hey, welcome back everyone. It is time for another red hot cover call video. Well, hey, look, a lot of people have been asking me to put together a very basic cover call writing video. We're going to talk about that, but more importantly, we're going to talk about some of the technical chart reading that we need to understand. You don't have to be an expert at this, but you have to have some sort of technical chart reading to understand when to have entries for the stocks that we're going to buy. Now, let me bring you up to speed real quick for those that do not know. When we write a covered call, what we're doing is this. We're telling the greater stock market, I own at least 100 shares of a stock. Now, that stock has to be optionable because what we're going to do is write a contract. What we're going to do, being that we own 100 shares of a stock, and in this case, we're going to be talking about PayPal because I love to use my covered call premiums to buy the Yield Max ETF PYPL. I have 100 shares. And what we're going to do is we're going to go to our brokerage and we're going to open up the very basic option trading window. And we're going to plug in the PayPal ticker symbol. Now, how this looks on your end might be a little bit different, but for the most part, this is the most basic of trading. You're going to plug in the PayPal ticker symbol. They already know you own 100 shares or more. You're going to select calls or puts. You're going to select sell to open. Remember, we're writing a contract, giving somebody the right, but not the obligation to take our shares away from us. So we are going to select sell to open. Now you're going to see other things in there like sell to buy and sell to close, open to close, this, that, and the other. Sell to open. We sell, sell, sell. Say that with me. Sell, sell, sell. There have been many times where people buy to open, and that would mean you're buying this call option and it puts you in a much different position. We sell, sell, sell. Now, because one contract equals 100 shares, you are going to put 1 in the quantity. We're not talking shares here. We're talking quantity of options contracts. And you have to understand that one contract equals 100 shares. So yes, to answer that question, you do need 100 shares to be doing this strategy. Now, with that said, you are going to select calls and you're going to select the expiration date. This is a typical 30-day trade. Some stocks will only show monthly. In PayPal's case, they will show weekly. But I usually pick that 30-day covered call because you can typically get a nice 3 to 4% premium, and that's what we're looking for. That's our wheelhouse trade. If I can collect 3% in the premium, plus a little bit of stock move like I'm going to show you, well, that's what we're looking for. And as you can see, the strike price is the price we're willing to give away our shares. So we own the shares at $54.47. We're willing to give them away to somebody for $60. That means somebody's going to buy these shares off us for $60. And of course, we're going to collect the premium. Now, this premium is what we talk about as printing money. See, I own PayPal, and if I own PayPal one day, 1 week, 1 month, they're not paying me a dividend. I'm literally owning the shares. But by giving somebody the right, but not the obligation to take my shares away from me, they're going to pay me a per share premium. They might take your shares because PayPal could trade above 60 on your expiration date. Okay, so we're going to talk about that, but you are giving somebody the right to take them away from you at 60. Quick recap. You're inside of your brokerage. You're going to go to your options window, sell to open, sell, 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 sell to open. 1, we're talking 100 shares. Obviously, if you have more than 100 shares, like 200 or 300, you could do 2 or 3 contracts. We're going to select the call. We're going to select the expiration date for which you're giving this person time to make that decision to buy your shares at their strike price, and that's 60. We're going to select the premium. Now, the premium here is set by the markets. It's not set by us, but we can actually put in a price that we want. See, there's a limit order here, and I always use limit orders, and I put my price in there. And what I usually do is try to get the mid every single time. I don't let them give me the bid because, remember, I'm selling the contract, so they might slap me with the bid price, and we leave a couple pennies on the table. So I always set the mid price. And if I can get the mid price, and that means I'm going to get $1.73 a share. Now, for 100 shares, that's going to be $173 deposited into my account, and I keep that money. Nobody takes that money. Remember what we're doing. We're giving somebody the right, but not the obligation, to buy my shares, my 100 shares, by April 5th. And they have to pay me $60. So that's a right, not an obligation. So when you write this contract, Don't think that somebody has to buy your shares at 60. If the stock finishes above 60, the market maker will take your shares and give you $60 per share. If it finishes below, you will keep your shares, you will keep your premium. Hey, that call buyer did not ask to buy your shares at $59.50. They wanted to buy them at 60. Now, we don't need to know why they wanted to buy them at 60. That's just the contract you sold, and that's how this works. But do understand, you are selling the right to sell your shares at 60. And whoever takes that right and they pay you $1.73 per share, they can take them for whatever reason, whatever price. Hey, there are times where you will have your shares taken away if it's profitable on the other side of the trade. And a lot of times that means a special dividend is going to be distributed or a dividend. Or they want to take your shares just for the hell of it. It happens, and it only happens in a very, very rare instance. But it can happen. Usually these options go to expiration, that expiration being April 5th. Now let's talk about the entry points if you don't own a stock. So for me, what I want to do, I want to always look at a stock and see where it's been trading. See, where people make mistakes is what they do is they get involved when the stock's trading at the high. See, the stock's made a nice rally, everybody's talking about it, and you buy at the high. What you need to understand is that's where almost every individual trader gets burnt. My absolute simple philosophy is we always look to buy near its support line. And support being where a stock will bounce and Wall Street will buy it. The resistance line would be where the stock tries to break out to new prices and it hasn't broke resistance. And if it breaks resistance and stays above there for 3 days, potentially that could be the new line of support. Now, with that said, let's add an indicator that I absolutely love. I use the Keltner channel, and the reason I do that is because the Keltner channel shows a stock's trading range. Now, I know this sounds very obvious, but let's take a look at a stock's trading range. PayPal trades in this beautiful range where it will play right at the mid, that Keltner channel mid, this being the top, this being the bottom. Well, we look at this chart because what I would like to do is get involved with our stocks when they're trading in the lower part of the Keltner channel. If you're buying them at the higher part of the Keltner channel, well, what do you think is going to happen? Unless there's some huge news or its overall sector is absolutely exploding, chances are the stock's going to trade right in its trading range. So that's when we can use the Keltner channel to identify good entries, or what I call to be more favorable entries. Because look, had you gotten involved here, you're kicking yourself because it fell to here. So nobody has a crystal ball, but what we try to do is put ourselves in a more favorable position. And the Keltner channel helps me with that, and what I love to do is back it out a little bit to see where a support line might be. In this case, you can see PayPal is dancing off of that line right there. And that seems to be about 57. And that's where I love PayPal right now. And even on a bad day when the markets were getting destroyed, PayPal didn't dip below 50. So it trading at 57, and that's near support, that's a more favorable entry for me. And that's what I would do. I would look to get involved with PayPal right around 57. You can see it's trading for 58. There's really no catalyst for this stock to move higher. So it's probably going to trade in this range. So we're going to go ahead and use that range to benefit us. So what we'll do is this. We will buy shares where we believe a good entry point is near support when it's trading below the Keltner channel mid. Then what we're going to do is write a covered call using the example I mentioned. With PayPal trading around 57, it trading up near 65 and then pulling back and now kind of finding itself. Look at the Keltner channel mid. The Keltner channel mid is 60. So if this thing gets above 60, you have your shares taken away, you make max profit, right? You bought the shares at 58.45, you're giving them away at 60, and you got $1.73 for it. That's how we do it. And if you do not have your shares taken away and it trades below the Keltner channel mid, that's fine. As long as it stays in that 57 range, we can do this every single month. If you find yourself getting stuck and the thing falls down to the 50s, well, guess what? That's just a part of the game. What we're going to look to do is use the expected stock move calculator that I have on my website, because we do not want to pick a strike price or a price to take our shares away that is under your cost basis of 58. So that's when we use that expected stock move calculator, and we're able to plug in the numbers, and it'll give us the expected move for the time frame we give the call buyer. Okay? So basically that's it. What we want to do is own 100 shares of an optional stock. We want to then sell a call option. And what we're going to do is we're going to use the number 1, right? 1 contract equal 100 shares. We're going to go ahead and select a time frame. Now in this case, I picked the 30-day trade, and we're going to pick the strike price, that being the price we're going to give the shares away. And we're going to pick the premium we want to get paid per share. I always select the mid, which would be a limit order. Say limit order with me, because what you don't want is to do a market order and you get the cheapest possible price, leaving some money on the table. Remember, options are not traded in real time. They are literally bids and asks sitting out there in the greater ether of the stock market. They're sitting there. That's where the market maker will dial up and down to pit buyers versus sellers. Although that happens in real time when a stock's trading some 6 million shares a day, not so much on the option side. It's very stale. And in fact, all option prices should be considered stale. That's why when you sell a call option, you select a limit order and you put the most expensive price, because you don't know if those bid and ask aren't old static numbers. It happens. Say for an example, the bid-ask spread is $1, $2, $3. If you come in and say $1, and when it refreshes and gives you $1, and you find out that you could have gotten $3 for that, that's when you kick yourself. So when you do a limit order, always ask for the max amount and then dial it down. Look, if you put in $3 in that example, then come back for $2.75, $2.50, $2.25, $2. Chances are they'll give it to you at $1.75. They usually like to give it one tick below the mid, but you never know. What you don't want to do is submit it and they give you $1. Hey, look, I'm going to leave it right there. The expected stock move calculator is for members only. It has videos on how to use it and how I use it. But if you email me, I'll send you a direct link. I won't sell you. I won't spam you. If you have questions, ask them. I'm sure there's tons of people in the comment that'll be willing to answer and help out. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.